stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined once again by Neena Mishra, Zach's Director of ETF Research and the all-knowing one on everything that's going on with ETFs here at Zach's. And there is a lot going on this year in 2023 with ETFs, as there usually is, but I feel like it's giving us a little bit more insight into some like market psychology, what might be going on in investors' strategies, because there's some interesting data coming out so far through May here in 2023. So the first 5 months of the year about the inflows and the outflows into these ETFs. Which ones are popular with the money going in, which ones are not with the money going out. And some of it has been quite surprising. And it's been talked about in the Wall Street Journal, on Morningstar, on Market Watch. Everybody's talking about this. So I thought I'd have Neena join us to share her insights about what she's seeing in all the data on the inflows and the outflows. And we can discuss what is going on out there with investors here in 2023. Is this a change from what we've seen in the last couple of years? And so welcome, Neena.
Hi, Tracey. Thanks for having me on. Yes, this year has been really interesting. So normally when we look at the inflows, ETF inflows and outflows, we see a lot of performance chasing, but that has not happened this year. You look at the technology stocks and you look at the QQQ ETF, the NASDAQ 100 index is up how much? 36%, 37% year to date now. But if you look at the inflows that you mentioned through the end of May, a lot of money has gone into defensive areas of the market, and overall inflows were very anemic compared to last 2 years. So in 2021, ETFs gathered close to $1 trillion in inflows. And then last year, when the market was terrible, that year also inflows were close to $600 billion. This year, barely any inflows and very few inflows into equity ETFs. Now, if you look at year-to-date inflows, including this month's, then I'm saying that fixed income has been an asset class which has been very popular with investors. It has gathered about 81 billion in inflows. And US equity ETFs, they now have just about 32 billion in inflows, and about a third of that came last week. So last week we saw some, investors trying to figure out where they should invest now, because a lot of money was parked in money market funds and in cash. We know that money market funds have gathered close to $600 billion this year. And that is mainly because of that 5%, close to 5% interest yield on money market funds. And so investors were not putting money into US equity ETFs. Inflows were very low. There are certain exceptions, though, that I should mention. Semiconductor ETFs did see some inflows. AI is a popular theme with investors. So AI-focused ETFs saw some inflows. For example, the Global X Robotics and Artificial Intelligence ETF that had a little more than $500 million in inflows. So there are certain themes which were popular, but overall flows were very, very anemic, and they mostly went into defensive areas of the market.
Yeah, and this does surprise me because we've just seen the investors chase for so many years. We saw it with Cathie Wood, with the ARK, and ARKK especially. Everybody chased into that ETF at the end of, in 2020 into 2021. And then that imploded. But even ARKK, because tech has rebounded this year, That's up 40% year to date, but yet it too is seeing money still coming out of that fund. Yeah.
Yes.
I am surprised.
So we talked about ARK inflows in 2020 and 2021 as well. So ARK gathered 20 billion in 2020 and another 16 billion in the first 6 months of 2021. So it was insane then. And we were talking about the issues, the complexities that could have been created by those kind of inflows. But it seems that investors just gave up after that. And this year, as you mentioned, ARK funds did quite well, but the funds have still seen outflows this year.
Yeah, I have 215 million outflowed so far in 2023, which is better than what was happening last year, obviously, but still outflowing, even though that ARKK is up 40%. And then I think really the key is that a lot of people got burned, buying at the top, as we saw, and we've talked about it on the show many times, because over the last 2 years, ARKK is still down 62%, even with the great performance year to date. And that kind of just goes to how long it takes to recover if you get a big sell-off. Even if you get the rebound, it will be years before those people who bought at the peak might even break even. So they usually just throw in the towel at some point and get out and move on to something else. But I am kind of surprised to see people pulling money out of some of the other kind of tech funds. I saw the XLK, that is seeing outflows as well, even though that one is up almost 37% year to date. And then over the last 2 years, that one is actually up almost 20% over the 2 years. But I was, wondering, I haven't looked at that one in a while. So I went to go look at the holdings thinking, I wonder what's in there that it's up, over the last 2 years. And then I remembered, yes, Microsoft is 24.2% of the whole XLK. And then you have Apple now 22.8%. So combined, just those two tech titans, both of which are at 52-week highs, are 47% of this ETF. And then taking a look at the top 10, it's mainly like old tech is how I would describe it. It's NVIDIA, Broadcom, Cisco is in there, those types of companies. So I'm not surprised this has done better performance than the ones that had Shopify and Zoom and Snowflake and those types of newer tech companies. But I am surprised that the money is still flowing out of this one. And is there some kind of theory about why it's getting out of this?
Yeah, so this is an interesting ETF now because the technology sector, after the reorganization, the GICS reorganization in 2018, and then earlier this year. So now this has become very much top heavy. And as you mentioned, Apple, Microsoft, NVDA, and that is the reason why it has done so well. But it has, again, seen outflows. It's just because investors, they do not believe the rally, it seems. It's not only the mom and pop investors. There was an article in the Wall Street Journal that hedge funds are also bearish on this, and they have a very high short positions, a high amount of short positions on the market. So it's interesting whether we will finally see that retail investors will start piling back into these technology stocks and ETFs. And as I mentioned, we did see some inflows into equity ETFs last week, even though, again, last week, a lot of money went into small caps and equal weighted S&P index ETF, which again is tilted more towards small and mid cap stocks. But the QQQM ETF, which is the cheaper version of the Invesco QQQ ETF, that also saw decent inflows, about $1 billion last week. So it seems that there was some performance chasing. Investors finally realized that these technology stocks and the QQQ index they have done so well this year. So let's buy this ETF. But in general, the defensive stance continues. So we will see what happens in the coming months.
Yeah, I am also surprised by the inflows into the small caps because, those are not defensive. So if you're thinking the Fed is going to manage to bring about a soft landing, and the small caps have been beaten up a lot, so why not do the contrarian play? Because small caps do well, coming out of a recession or a slowdown usually. And so maybe that's why they're piling in, but they've just been terrible for many years.
Right.
So
For small caps, I think it's a play on valuations, because if you watch CNBC and Bloomberg, you know that almost every expert, so-called market experts, they keep on saying, oh, small caps are screaming buys at these valuations, and big tech, the mega caps, 8 stocks or Magnificent 7 or whatever, they have run up too much, too fast. So maybe we should see some rotation into small caps later this year. So that could be a valuation play, in my view.
Or it's almost like a defensive play without actually shorting the, the NASDAQ. But they do feel like that's overdone now. So we're going to go into the opposite thing that has been terrible. But yeah, I'm okay with that. I'm okay with the non-chasing and being the contrarian. I feel like that's a little bit more stable type of investing, and it's kind of healthy for the market. I think it's healthy that we're not seeing everybody rush into, QQQ or QQQM, even though $1 billion did go into the M last week. It's still relatively tame, and, there's still more people on the defensive side or even in the money market accounts than are trying to chase this tech rally, which has been amazing. Even just on the NASDAQ, I heard today on June 13th that the NASDAQ is having its best start to the year since 1991. So it's been a long time since we've seen even better than 99, the start to the NASDAQ. But apparently a lot of people think it is going to peter out here. Let's talk about one of the other ETFs we have talked about on this show before, and that's the Meet Kevin ETF. It's was launched in the end of 2022 by Meet Kevin. He's a YouTuber, and he describes himself as a 31-year-old dad and financial analyst. He has 1.87 million subscribers on YouTube, but a lot of people like to follow him for financial advice. So he's launched his own ETF, and we brought it up on a prior podcast just after the launch. We kind of saw it as like a sign of that there was still speculation out there, and, people still wanting to chase into a lot of the tech stocks because that's basically what he owns. His largest position is Tesla at 25% of this ETF. But lo and behold, Meet Kevin ETF is doing really well here in 2023. But what's happening with the inflows to the Meet Kevin ETF? Is that like a new ARKK, or are people still being relatively subdued even on the Meet Kevin one?
Yeah, it's still very subdued. So if you look at the top performing ETFs this year, the first one is a Bitcoin miners ETF. The ticker symbol is WGMI, which is up 131% this year. And then there are a bunch of other Bitcoin and Bitcoin miners ETFs, then a microsectors FANG Plus ETN, which basically holds 10 FANG and FANG Plus stocks. Not holds, it's an ETN. So it tracks the performance of 10 FANG and FANG Plus stocks. And then you have some actively managed ETFs, including this one by Meet Kevin, the Meet Kevin ETF. This is up 52% year to date, and there has been no performance chasing. It just has about 31 million in assets. And if you look at the holdings, Tesla is the top holding currently. It accounts for almost 29% of the portfolio now, and that explains the performance. And Apple is the second largest holding with about 13% weight. So, and this ETF charges 77 basis points. So do you really want to pay that kind of fees to an active manager who has such a concentrated portfolio? So it seems that maybe investors have become wiser. So they are not running into the ETFs or other ETFs like this, like the other ones, the top performers that I mentioned, they are also not gathering assets at all, particularly the Bitcoin and Bitcoin miners ETFs, which have done so well this year. They have seen very, very little interest from investors. And I think in case of cryptocurrencies, because last year was brutal, very painful for investors. So many investors just gave up on the asset class, and also because there have been so many high-profile frauds in the space. So that also made some investors nervous about the asset class. So there has been no performance chasing of either these actively managed ETFs like Meet Kevin ETF or the Bitcoin and Bitcoin miners ETFs.
Yeah, that's really interesting to me about the Bitcoin, the crypto ETFs, the mining ones. I mean, it's got to be one of the first times in years, maybe decades, that an ETF could be at the top as the best performer, but nobody cares. Nobody's putting money in there. That's like a weird thing. It's just strange to me to see this happening. But I think it is interesting to see what's happening this year in the ETF inflows and outflows. That's why I had you on. But also what it does tell us maybe about market sentiment, that a lot of the speculation we saw during the pandemic, people, trading on their phones and all of that, and maybe even with their stimulus money, as we know, that has ended. That's gone away.
So the top performing ETF that we mentioned, WGMI, this has less than 10 million in assets. So I wouldn't even be surprised if it liquidates in some time. In fact, one of the crypto miners ETFs, which was one of the best performing at the beginning of this year, that has already been liquidated. So yes, investors are still very wary of this asset class. They are not putting any money into these crypto and crypto miners ETFs, despite the performance this year.
Yeah, right. They've learned that may not be the place to be. So what are the, out of the ones that are not like the Bitcoiners, is it like bond funds that are some of the better performers? Or, I mean, where is it a good performance and some money is going into it?
Yes. So in terms of performance, of course, the chip ETFs have been one of the best performing areas of the market, and they have seen some inflows as well. Some actively managed ETFs that I mentioned, they have done well. And that is mainly because they either have a lot of exposure to Tesla or to NVDA or to both. Yeah. So that explains the performance of those ETFs. And apart from that, technology-focused ETFs have done quite well. But if you look at the inflows, as I mentioned, bond funds saw a lot of inflows. The performance hasn't been that good. International ETFs have seen decent inflows, and Japan ETFs, the hedge Japan ETFs, have also seen decent inflows, and that is mainly because of their performance, because the Nikkei is up more than 20% this year. So investors are warming up to Japanese ETFs. That is an asset class which has the good performance as well as inflows too. So one of the exceptions, and as I mentioned, AI-focused ETFs have both good performance and some investor interest too. A new ETF which focuses only on generative AI. It's the first and only ETF so far which focuses on generative AI that launched just a couple of weeks back and already has 60 million in assets. So that that's quite impressive for this kind of market environment. And then there are some single stock ETFs, the one which is focused on Tesla, which provides 1.5 times exposure to Tesla stocks. Tesla stock, the ticker symbol is TSLL. That has 700 million in assets, a lot of which came this year. So that is also pretty impressive. That is an area where we see some performance chasing. Investors are putting money in the leveraged Tesla ETF mainly because of its performance. Some inflows into NVDA leveraged ETF as well.
Yeah. So what is the ticker for the generative AI that got 60 million in assets already? Do we know?
Very interesting ticker, CHAT, CHAT.
Oh, okay. Because someone already has the AI ticker, obviously, so they gotta come up with some new ones for these other ones. Yeah. But this makes sense. Okay, I'm going to keep an eye on that one because that could be pretty hot. Is Microsoft the largest holding in that, or?
So yes, NVIDIA is the top holding with about 8% weight. Microsoft also has about 8% weight, and Alphabet about 7%, and then you have others including Baidu and Adobe and AMD, etc., etc.
Yeah, these early generation AI type ETFs that they're kind of rushing out to launch remind a lot of the initial cannabis ETFs when there weren't like that many companies in that space yet. And there still aren't that many on cannabis side, but people thought there would be later. But so you kind of grasp for, you take the main names, but those aren't really enough. And then you have to kind of grasp for some kind of link into all the others to get enough stocks in there. So I'm not surprised that it has, the biggies, obviously, like NVIDIA and Microsoft and Google and those names, because that's all that we know really out there.
Yeah. So in case of AI, I think it's easier for providers because if you think of AI, who are the companies who are investing a lot in AI? It is the biggies. It's the Microsoft, it's the Google, and who will benefit the most? It's the big ones and the ones that are supplying the chips and GPUs, so NVIDIA, so that makes a lot of sense. It's good for investors also because the ticker that you mentioned, AI companies like C3 AI, which are one of the very few pure play AI companies, but they are so risky. So it's investors are safer investing in the big ones.
And I wonder if some of the companies that came out with like FANG ETFs back in the day, there are several of them, I believe, right? That just, have the FANGs or the FANGmen stocks in there. If they won't just kind of rename it and they'll just be like, we're really an AI ETF now. We'll just change the name because it's the same companies, right? And then they'll go with the hotter name kind of in the thing, but I guess we'll see. We'll see what happens with those. But that's possible. What I would be thinking. Yeah.
And that's very much possible. That would be interesting.
Yeah. Okay. Is there anything else we should know that we didn't cover about the ETFs, the inflows, the outflows?
I think we have covered everything. But the main thing to watch going forward is whether investors who have been sitting in those money market funds or cash, whether they would finally realize that, okay, I was earning 5% yield on my money market fund, but at the same time, NVIDIA went up 2 times or 3 times, whether they'll pull the money out of money market funds and pile back into these hot stocks or ETFs, and whether that is going to be too late, because investors, we have seen that they're always bad with their timing, market timing. It is always better to stay invested for the longer term, and you make money that way, whether you are, and it's better to have a diversified exposure, more to stocks and to many stocks and broad plain vanilla ETFs, and maybe some exposure to bonds and money market funds too, depending on your cash needs and your risk tolerance.
Yeah, that's good advice. Okay, well, we'll we'll check in, later on this year and see what happens, because it's always good to know and to follow the inflows and the outflows on the ETFs, because it does give us a lot of clues on like what investors are doing with their money, obviously. And right now, they're mostly in cash, sitting on the sidelines in the cash. So yes, we will have you back on, Neena, as always. Okay, so we did cover a decent number of tickers on today's show, both stocks and ETFs. So I'm going to start with the Bitcoin mining ETF that Neena mentioned, but it's up the most this year, but nobody's in it. It has less than 10 million in assets now, and it's ticker WGMI. W as in Wayne, G as in George, M as in Mary, I as in Ian. Then we did talk about Cathie Wood and ARK. It's up 40%, the flagship fund here in 2023, but we're still seeing outflows there. And it's ARKK is the ticker. We talked about Meet Kevin. He's seeing some inflows with his big gains for the year because Tesla's his largest holding. That ticker is P as in Paul, just PP. Then we talked about Tesla, of course, TSLA, NVIDIA, NVDA. We talked about Microsoft a little bit, MSFT. We talked about the XLK ETF. That's the Technology Spider ETF, but that's the one with Microsoft and Apple at 47% of the ETF. And then we talked about the triple Qs, the QQQ, founded in 1999, but the cheaper version is popular this year, QQQM as in Mary. It's little less expenses on that one, QQQM. And then we talked about the single stock ETF, if you want Tesla single stock ETF, TSLL. And if you're interested in Japan, there is one of the just basic ETFs there is the iShares, and it's just EWJ. That's been around for forever. So you can start checking out Japan ETFs with that one, but there are other ones also out there on Japan.
So, Tracey, sorry to interrupt. Let me quickly add that in case of Japan, usually currency hedged ETFs are slightly better for investors, particularly because usually Japanese stocks go up when the currency is going down. So most of the performance in the Japanese stocks can be, not most of the performance, some of the performance can be attributed to the weakening of the yen, because Japan, as we know, is still an export-oriented country. So DXJ is the currency hedged ETF. EWJ, the bigger ETF, is unhedged ETF. So if you want exposure to both the currency and stocks, then look at EWJ. But if you are worried about continued weakening of the yen and you want to take the currency equation out of the ETF, then look at DXJ.
Okay, good advice. It always pays to talk to the head of research here at Zacks to find out which is the one you really want to be in. So make sure you tune in to our next podcast when Neena is on, because she knows all about what's going on with ETFs, and there is a lot going on. So make sure you join us here. You can get us on Apple Podcast. We're on Spotify. We're on Amazon Music. Or you can get us on Zacks.com. There's a podcast link right up at the top. You can tap on that. Find all of our podcasts, including Neena's, on ETFs every week. You want to get that one, but be sure to get us somewhere, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.